Okay, folks, now we're going to take a look at what is known as the Impossible Trinity. This is actually a very sort of an old idea in economics. It's a very, I think, it's a very useful way of thinking about the relationship between monetary regimes, financial or capital flows, and the exchange rate. And Mankiw has a really nice discussion of it, 393, 394, but we thought we'd go into a little bit deeper. So anyway, the idea of this triangle, this impossible trinity, is that there's 3 points on this triangle. You can set independent monetary policy, that's this point, completely independent. You can have full capital mobility, and you can have you have down here a fixed exchange rate. But the idea is that you can have only 2 of these, but not all 3. So if you want to set independent monetary policy, you either have to give up your exchange rate target, or you have to restrict the flow of financing of financial instruments, what we call the capital flows. We have to restrict that, and we'll see why. Okay. So there's questions. If a country has full capital mobility, in other words, if the financial flows are free to come and go and come and go, and it wants independent monetary policy, then why does the exchange rate need to be flexible? And I think that's a perfectly legitimate question. I think we need to go, we're going to go into this a little bit more deeply. I promise you this will not be on the quiz, but this is, the idea is that it's the adjustments in the exchange rate that will, in a sense, equalize rates of returns between countries, even if interest rates diverge, okay? So let's think about this. Let's suppose that initially we have the euro interest rate equal to the US interest rates. Everything is in an initial situation just the same. And then all of a sudden, the US Monetary Authority raises interest rates, but the Euro Authority does not. Now here I have to think about a French investor. Okay, what's the French investor going to say? He's going to say, "Ooh la la, sacre bleu." Okay, we have higher interest rates here in the United States. Okay, so this French investor and everybody else, they're going to be buying U.S. assets. And when they do that, the U.S. dollar will appreciate relative to the euro. Okay? Once again, you need to recall that tighter money means a more valuable currency. Mankiw makes that very, very clear in his book. Okay? But the idea is that the appreciation is instantaneous appreciation is actually going to wipe away the extra return. Okay, so how to think about that? Think about a bond price. Okay, so let's say that you have a bond that matures in 1 year at 100, and the price of the bond today rises from 96 to 98. That means the rate of return has gone down roughly from 4% to 2%. So it's the same thing with the exchange rate. The exchange rate is adjusting to keep the effective rate of return the same. So no more ooh la la by the French investor. Okay. Now, then, more importantly, why is it not possible for a country to pursue an independent monetary policy when the exchange rate is fixed and there's full capital mobility? And the answer is, well, look, money is going to be moving between countries. It's going to undo the intentions of the central bank, undo the intentions of the monetary policy. So let's say that you have, for a split second, interest rates move up in the fixed exchange rate economy relative to the US, okay? If that even begins to happen, what will happen is investors will rush in. Remember, we have full capital mobility. What that means that that the money is freely flowing across borders. So investors do this very quickly, and they will drive up the price of bonds in a fixed exchange rate country, and they'll do it just enough to bring the world interest rate back to the U.S. interest rate. We have a name for that, business students. It's called arbitrage. So if you're going to be a business student, you need to know about arbitrage. Okay, so then if a country imposes capital controls, can they have both a fixed exchange rate and an independent monetary policy? And the answer is, well, perhaps. But, here you have to think of like you're shutting a door. Okay, boom. Okay, but the money is always going to be finding a way through the cracks. Okay, the crack in the bottom of the door, the crack. It's going to be looking either for a better rate of return. So if you're shutting the door on this better rate of return, the money will find a way through the cracks. So it's the topic that a lot of economists have been discussing about the effectiveness of capital controls is, well, okay, you put a law, you say, we're restricting your movements of money, but then investors find a way around it, and how clever they can be, and sometimes they can be very, very clever. So that's basically it for the Impossible Trinity.